Welcome to Math for Financial Monitoring. In this lesson, you will learn how mathematics can help you with financial monitoring. Whether you're managing your personal finances, analyzing a business's performance, or monitoring a country's economic performance, math plays a crucial role in making informed decisions. We will cover three main sections in this lesson: personal finance analysis, business finance analysis, and national finance analysis. By the end of this lesson, you'll have a better understanding of how to use math to make more informed decisions. Let's get started. Introduction to financial monitoring. Financial monitoring is the process of keeping track of your finances. It helps you understand where your money is coming from and where it's going. Why is financial monitoring important? It helps you budget your money effectively. It helps you save money for the future. It helps you plan for major expenses such as buying a house or car. It helps you avoid debt. How can mathematics help? Mathematics is an important tool for financial monitoring. It can help you calculate your income, expenses, and savings. Mathematics can also help you analyze your financial data. It can help you identify trends and patterns in your spending. By using mathematics to monitor your finances, you can make informed decisions about your money. You can use the data you collect to adjust your spending habits and make sure you're on track to meet your financial goals. In summary, financial monitoring is important for managing your money effectively. Mathematics is a useful tool for financial monitoring, helping you calculate, analyze, and make informed decisions about your finances. Personal finance analysis. Personal finance analysis involves calculating personal expenses, income, and savings to make informed budgeting decisions. It's important to track your finances to ensure that you are meeting your financial goals. Calculating expenses. To calculate your expenses, you need to add up all the money you spend each month. This includes expenses like rent, mortgage, utilities, groceries, transportation, and entertainment. Calculating income. To calculate your income, you need to add up all the money you earn each month. This includes income from your job, investments, and any other sources of income. Calculating savings. To calculate your savings, you need to subtract your expenses from your income. This will give you your monthly savings amount. Budgeting decisions. Once you've calculated your expenses, income, and savings, you can make informed budgeting decisions. You can adjust your spending habits to increase your savings or allocate more money towards expenses. Tips for budgeting. Keep track of your expenses and income using a spreadsheet or budgeting app. Set financial goals for yourself. Make a budget and stick to it. Look for ways to cut expenses. By tracking your finances and making informed budgeting decisions, you can achieve your financial goals and improve your financial situation. Business finance analysis. Common financial ratios. Financial ratios are used to analyze a company's performance over time. They are used to compare the performance of one company to another. Profit. Profit is the amount of money a company makes after all expenses are paid. Profit is calculated by subtracting expenses from revenue. Revenue. Revenue is the total amount of money a company makes from sales. Revenue is calculated by multiplying the number of units sold by the price per unit. Expenses. Expenses are the costs that a company incurs in order to operate. Expenses include things like rent, salaries, and cost of goods sold. Financial ratio, gross profit margin. Gross profit margin is the percentage of revenue that remains after cost of goods sold is subtracted. Gross profit margin is calculated by dividing gross profit by revenue. Financial ratio, net profit margin. Net profit margin is the percentage of revenue that remains after all expenses are paid. Net profit margin is calculated by dividing net profit by revenue. Financial ratio, return on investment. Return on investment is the amount of profit generated by an investment relative to the cost of the investment. Return on investment is calculated by dividing net profit by the cost of the investment. Financial ratio, debt to equity ratio. Debt to equity ratio is the amount of debt a company has relative to the amount of equity. Debt to equity ratio is calculated by dividing total liabilities by total equity. National financial analysis. Key economic indicators. Key economic indicators are statistics that measure the economic performance of a country. Gross domestic product. Gross domestic product, GDP, is the total value of goods and services produced within a country's borders in a given period. Inflation. Inflation is the rate at which the general level of prices for goods and services is rising and, subsequently, purchasing power is falling. How is GDP calculated? GDP is calculated by adding up the total value of all goods and services produced in a country during a specific time period. How is inflation calculated? Inflation is calculated by measuring the percentage increase in the price of a basket of goods and services consumed by households. Other key economic indicators include unemployment rate, consumer price index or CPI, balance of trade, and interest rates. National finance analysis is important because it helps governments and businesses make informed decisions about the economic policies and investments. Thank you for joining. This brings us to the end of our lesson.